If you reinvest your dividends, a $10,000 investment can turn into $260,000 over time. No extra money added, no market timing, no luck, just one simple strategy, running on autopilot. Let me show you exactly how it works, step by step, with the math to back it up, because once you see how dividend compounding actually functions, you'll understand why the wealthiest long-term investors in history have been using it for decades. This is not a get-rich-quick scheme. This is not a trading strategy. This is a system. And by the end of this video, you will know how to build it, set it up, and let it run, while you live your life. If that sounds like the kind of content you've been looking for, hit like right now, and subscribe. Let's get straight into it. Before we get into the compounding engine, let's lock in exactly what dividends are, because this is where most beginners have a gap in their understanding. When you buy shares of a company's stock, you become a part owner of that business. When that business earns a profit, it has two choices: reinvest the money back into operations and growth, or distribute a portion of it to shareholders. Those distributions are called dividends. Most dividend-paying companies send payments every quarter, 4 times a year, deposited directly into your brokerage account. No action required from you. You own the stock. The money arrives. Some companies have been doing this reliably for extraordinary lengths of time. There's a formal group called Dividend Aristocrats, S&P 500 companies that have not just paid dividends, but have increased their dividend every single year for 25 years or more. Through recessions, financial crises, pandemics. Every year, a bigger payment. Now, here is the core mechanism, and I want to be precise about how it works, because the simplicity of it is what makes it so easy to underestimate. Instead of spending your dividend payments, you reinvest them. You use that cash to buy more shares of the stock that just paid you. Those new shares also pay you dividends next quarter. You reinvest those too. Every cycle, you own slightly more shares. Every cycle, your dividend income grows. The growth rate accelerates over time, not linearly, but exponentially. Here is what that looks like in real numbers, starting with $10,000, a 4% dividend yield, dividends fully reinvested every quarter, modest 2% annual dividend growth, no additional money added. $32,434 from a single $10,000 investment, with nothing else added, ever. But now, let's add one thing. Just $200 per month of additional contributions, same 4% yield, same reinvestment, same conditions. Watch what happens. That is not a rounding error. That is the difference between a supplement to your income and complete financial transformation. $200 per month, roughly $6 or $7 per day, compounding alongside your dividends for 30 years, produces a result that most people would call impossible. It is not impossible. It is math. This is why starting early matters more than starting with more. Time is the multiplier. Money is just the seed. Knowing the theory is one thing. Building the actual portfolio is another. There are 5 pillars that define a high-quality dividend compounding portfolio, and skipping any one of them increases your risk significantly. Pillar 1. Dividend yield. The annual dividend payment is a percentage of share price. A 4% yield on a $100 stock means $4 per year per share. The trap for beginners, chasing the highest yield available. 8%, 10%, 12% yields look attractive. They are almost always warning signs. An abnormally high yield typically means the share price has collapsed, or the dividend is about to be cut. All then fades to a green band labeled quality yield range, 2%, 6%. Pillar 2. Dividend growth rate. This is more important than current yield. A company paying 3% today and growing at 7% per year will pay you more than a flat 5% yield within just a few years. And dramatically more within a decade. You are not just buying yield, you are buying a growing income stream. Pillar 3. Payout ratio. What percentage of earnings is paid out as dividends? A healthy range, 40% to 60%. It means the company rewards shareholders while retaining capital to grow. A payout ratio above 85%, 90% is a structural warning. The dividend may not be sustainable if earnings dip even slightly. Pillar 4. Sector diversification. No portfolio should be concentrated in a single sector. A strong dividend portfolio spans consumer staples, healthcare, utilities, financials, industrials, and optionally REITs. When one sector faces headwinds, the others continue paying. Pillar 5. Business quality. Dividend history is only as good as the underlying business. Look for companies with strong balance sheets, manageable debt, durable competitive advantages, and products or services that people need regardless of economic conditions. These are the companies most likely to keep raising dividends through recessions, corrections, and unexpected shocks. If this is clicking for you, drop compound in the comments right now. It takes 2 seconds and it tells me this content is landing. The mechanism that makes dividend compounding effortless is called a DRIP, a dividend reinvestment plan. Here is how you set it up in practical terms. You open your brokerage account, you locate the DRIP or automatic dividend reinvestment setting, you enable it. From that point forward, every dividend payment you receive is automatically converted into additional shares of that stock, often commission-free, often including fractional shares. So even a small $47.82 dividend does not sit idle. It immediately becomes 0.83 shares, which will themselves pay a dividend next quarter, which will buy even more shares. Nothing is wasted, nothing sits in cash, the machine does not stop. Multiply this across 5, 10, 15 different dividend positions, all paying quarterly, all reinvesting automatically. Your portfolio grows every single quarter without a single additional action from you after the initial setup. The DRIP also removes the most dangerous variable in investing, your emotions. You do not need to decide when to reinvest. You do not need to watch the market. In fact, when prices drop, your dividends buy more shares at a lower cost, which accelerates your future compounding. A market dip becomes an automatic opportunity rather than a reason to panic. This effect is called dollar cost averaging. When combined with dividend reinvestment, market volatility works for long-term investors rather than against them. DRIP investing alone, held consistently for decades, produces remarkable results, but there are 3 specific moves that can significantly accelerate what the numbers produce. Strategy 1. Regular contributions. We covered this in the compounding section. And it is worth repeating, because it is the highest leverage action available to most investors. Even $100 to $200 per month directed into quality dividend stocks compounds alongside your existing dividends. Over 30 years, the difference is not incremental, it is transformational. Start with whatever you can. Increase the amount as your income grows. Strategy 2. Tax-advantaged accounts. Dividend income is taxable in a standard brokerage account, typically 15%, 22%, depending on your situation. That tax drag, applied every year to your compounding, meaningfully reduces your long-term outcome. Inside a Roth IRA, your dividends grow completely tax-free. Inside a traditional IRA, they grow tax-deferred. Holding your dividend stocks in these accounts allows the full dividend to compound. Nothing extracted by taxes until you choose to withdraw. Strategy 3. Buy dips with intention. While DRIP handles automatic reinvestment, experienced dividend investors direct additional cash into their highest quality holdings during significant market corrections. When a strong business goes on sale, 20%, 30%, 40% below fair value, your dividend dollars buy substantially more shares. Those shares generate more dividends, which compound at a higher base. The correction that scares most investors out of the market is, for a disciplined dividend compounder, an opportunity to accelerate years of growth. Here is the part of dividend compounding that no algorithm can optimize for you. The strategy is not complicated. The math is not complicated. The brokerage setup takes 15 minutes. What is complicated, for most people, is the inaction, the ability to build the portfolio, turn on DRIP, set up contributions, and then do nothing. Not nothing for a week, nothing for years, for a decade. Most investors fail not because their strategy was wrong, they fail because they interrupt the process. They see a 15% drawdown and they sell. They hear about a new sector and they rotate. They check their portfolio every day and make small adjustments that collectively destroy the compounding chain. The investor does nothing visible, just waits. The machine works anyway. The compounding investor's edge is not superior stock picking. It is superior behavior, the ability to stay in a boring, reliable, quietly growing system while everyone else chases noise. Dividend compounding does not reward excitement. It does not reward activity. It rewards stillness and time. The market rewards patience. The question is, do you have it? Let's recap what you now know. Dividends are regular profit-sharing payments companies send to shareholders. Compounding is reinvesting those payments to buy more shares, which generate more dividends, which buy more shares, exponentially, over time. DRIP automates this entirely. The 5 pillars: yield, growth rate, payout ratio, diversification, and business quality give your portfolio durability. And the turbochargers, contributions, tax-advantaged accounts, and strategic dip buying, amplify everything. This is not the strategy that makes headlines, it will not trend on financial Twitter, but it is the strategy that actually works, over years and decades for investors who understand it and have the discipline to leave it alone. You now understand it. The only question that remains is the one worth sitting with. The market rewards patience. The question is, do you have it? If this video gave you clarity, like it right now and subscribe so you never miss content like this. That's it. See you in the next one.